Let's get to the broader markets now. Our next guest says the rally can still hold into year-end. Let's bring in Natixis' Jack Janasiewicz. JJ, good to see you. Thanks for joining us.
Thanks for having me back. Yes, pleasure to be back.
So there has been a real bullishness to the rally recently, and you say this can hold into year-end. Does that mean hold and make big advances, or hold being we'll sort of chug along?
Yeah, I think we continue to grind up into the end of the year and potentially go out at new highs. And I think the key to this is really what we're seeing out of the Treasury market. And one of the things we keep saying is I think the market may be getting a little bit ahead of itself in terms of pricing in some of that really overly hawkishness. And we expect maybe we get a little bit of some softer data over the next couple of prints. And that takes a little bit of the edge off the Treasury market. And that might take a little bit of the edge off the dollar strength. And that might be enough just to get a little bit of a catalyst into the end of the year. Match that up with the seasonals, and I think that's a pretty good backdrop here as we finish out 2024.
Jack, when you look at concerning the Fed, when you look at a term that you've used, the peak hawkishness, do you think that we're really there, and will that continue to be a tailwind for the markets, or have the markets already priced in that and are repricing in something else?
I think we've gotten to the point where we're starting to price in quite a bit in terms of the hawkishness, right? If you go back to when we were really pricing in the majority of the rate cuts, towards, let's call it the end of September, you're looking at 10 cuts. Now the market's closer to pricing in 3 cuts in here. And, I think when you start to look at that backdrop, the market's probably looking a little bit farther into the Trump administration. A lot of what we heard on the campaign trail not necessarily gets done in here. So maybe that takes a little bit of the edge off in there. And on top of that, again, we go back to there's probably going to be a little bit of softening in the data. Are we going to fall off a cliff here and push into a recession? Probably not. But I think that gives us a little bit of a range. The upside's probably capped because of that peak hawkishness. But at the same time, I think there's also a floor in terms of how much growth will slow. That probably puts the economy in pretty much a sweet spot in here.
It sounded, Jack, according to the notes, that you were a little bit skeptical in terms of what the bullishness around the Trump administration and what it could possibly do would actually do for the markets, mainly because of the backdrop. We're entering this year, his latest administration, with a very different backdrop than back in his first administration.
Starting points matter, right? If you sort of look at the 2016 blueprint, and I think that's what the market has been following over the last couple of weeks in here, that starting point was very different, right? You were looking at Fed funds coming off of zero interest rate, that lower bound. You were looking at 10-year yields at close to 2%. You were looking at, debt to GDP of about 75%. You go through the list on and compare that to where we are today, very different backdrop, right? Fed funds at 4.5, 475. You're looking at the 10-year at 440, debt to GDP now at 120%. The deficit at 1.8 trillion. Those starting points matter. I think it puts a little bit of a lid in terms of how much of that upside to growth we can really price in, because I think you're going to get a little bit of self-correcting mechanism, especially from the bond market, if things start to accelerate to the upside.